U.S. banks are currently facing a dire situation as they close numerous branches and lay off thousands of workers. These actions are clear warnings of an impending financial meltdown that is starting to unravel. Recent reports indicate that banks are preparing for the chaos that lies ahead by reducing their physical presence and preparing for potential mass withdrawals. With record high interest rates and turmoil in the real estate industry, major financial institutions such as JP Morgan, Wells Fargo, and Goldman Sachs have already reported significant losses in recent months. Aware that a much larger crisis is looming, these banks are becoming increasingly cautious with their finances. The pressure on banks has prompted them to close a staggering number of branches. In the first week of October alone, an alarming 54 branches were shut down, leaving a growing number of Americans without access to essential financial services. Notably, Bank of America closed 21 branches during this time, while Wells Fargo eliminated 15. U.S. Bank and JP Morgan Chase also contributed to the closures, shutting down 9 and 3 branches respectively. Additionally, Santander and City Bank recently closed nearly 20 branches each. Bank executives have stated that they are placing more emphasis on their online platforms, expecting consumers to conduct a greater portion of their banking transactions digitally. As a result, they are continuously reducing their physical presence, using the resulting savings to boost their bottom lines and invest in evolving technology. However, some analysts argue that these decisions are not solely driven by practicality, but also by strategy. With fewer branches available, only a limited number of customers will have the opportunity to withdraw their money from the system in the event of a crisis. Ultimately, these reductions also serve to limit potential losses for financial institutions in such situations. Experts suggest that we are only witnessing the initial stages of another global financial crisis, and conditions are expected to worsen. The fear of impending chaos has led banks to tighten their finances, reducing their brick-and-mortar footprint and slashing their workforce. The situation is undeniably grim, with many Americans left without access to vital banking services and the future of the financial industry hanging in the balance. The closure of bank branches has intensified, resulting in a net total of 2,927 branches closing from 2021 to 2022. This represents a significant 38% increase compared to the previous year. In the ongoing month, the number of closures continues to outpace the openings. For instance, JP Morgan closed 144 branches while only opening 103. This shift in focus can be attributed to banks aiming to attract younger customers who prefer online transactions. They are now actively competing for deposits as more Americans tap into their savings, leading to increased outflows. This situation leaves banks vulnerable to experiencing a liquidity crunch. In response to these changes, Santander, a representative from one bank, expressed the institution's intention to reimagine the customer and employee experience by simplifying processes, redefining branch footprints, and investing more in digital capabilities. Similarly, Wells Fargo stated that they routinely evaluate their branch network to accommodate shifting customer needs and the rise in digital banking. However, the negative repercussions of these closures loom large. Many individuals could potentially lose access to funds in the event of online bank outages or disruptions in internet connectivity. As a result, communities are noticing a significant decrease in the number of banks available compared to just a few years ago. A recent poll conducted by DailyMail.com indicated that 51% of consumers expressed concern about the declining number of bank branches. This sentiment is justified since individuals now have to travel greater distances to reach a bank, and even in the open branches, there are fewer staff members available to assist customers. The uncertain outlook for next year is prompting banks to take proactive measures to mitigate potential risks. Chris Marinac, research director at Johnny Montgomery Scott, stated that job losses in the financial industry could exert further pressure on the broader U.S. labor market, leading to a decrease in economic activity. Additionally, many banks are already experiencing a surge in defaults on corporate and consumer loans, which necessitates deeper cuts to stay afloat. Marinac emphasized the urgency for banks to find ways to prevent a further decline in earnings and allocate funds for provisions as more loans continue to deteriorate. Among the banks implementing significant layoffs are Wells Fargo and Goldman Sachs. Both institutions have been grappling with revenue declines in critical business areas. Wells Fargo, in particular, witnessed a rise in job cuts after announcing a strategic shift away from the mortgage business. Despite eliminating 50,000 employees over the past 3 years as part of CEO Charlie Shaw's cost-cutting plan, the bank will continue to downsize its workforce, as stated by executives on Friday. CFO Mike Santomassimo confirmed that very few areas of the company would be spared from reductions. Analysts further detailed that while attrition has remained low, additional severance expenses are expected in 2024. Similarly, Citigroup is also preparing to reduce its staff count. CFO Mark Mason revealed to analysts last week that the bank has identified 7,000 job cuts associated with $600 million in repositioning charges disclosed thus far in the year. CEO Jane Fraser's plan to revamp the bank's corporate structure, coupled with the sale of overseas retail operations, will further decrease headcount in the coming quarters. These developments underscore the troubling state of the banking industry. The turbulence in the economy is anticipated to compound the challenges faced by financial institutions during the final months of the year. Recently, the Conference Board's index of leading economic indicators confirmed an 18-month consecutive decline, further adding to concerns about the financial world's future. Speaking on this matter, Houston Scalamanica, the senior manager of business cycle indicators at the Conference Board, stated that while last month saw a slight improvement in the LEI for the U.S., the overall trend still indicates the presence of economic weakness in the future. In fact, the Conference Board forecasts that the pressures caused by higher rates will reach crisis levels in the first half of 2024. Taking into account the hard data and the challenges faced by Americans due to the rising cost of living, it is evident that the economy is not heading in the right direction. Notably, the number of business bankruptcies during the first 9 months of 2023 has surpassed the levels seen a year ago. Epic Bankruptcy reported that a wide range of U.S. companies have faced significant struggles this year, with commercial bankruptcies increasing by 61% and small business filings rising by 41% compared to the same period in 2022. Additionally, after the financial support programs implemented during the pandemic came to an end, more consumers have begun to file for bankruptcy. Personal bankruptcies have increased by 17% to 338%, as noted in a report. According to Lawrence Young, the chief economist at AAS, the issue of low housing affordability has continued to hinder home sales throughout this year. He emphasized that the Federal Reserve cannot continue raising interest rates due to decreasing inflation and weakening job gains. However, the central bank has stated that more rate hikes are necessary to reach its 2% inflation target, which may lead to an increase in foreclosures in the coming months. Home foreclosures have already risen by 34% compared to the same period last year, with foreclosure filings in the third quarter surging by 28%, as reported by real estate data provider Atom. Rob Baba, the CEO of Atom, stated that some homeowners are still dealing with financial challenges resulting from the pandemic or encountering new difficulties. Additionally, the report from Atom revealed that there have been 37,679 properties with foreclosure filings in the past 30 days, marking an 11% increase from the previous month. Experts predict that mortgage loan defaults and foreclosures will continue to rise due to the resumption of student loan payments. The end of the freeze on federal student loan payments in early October is expected to have a significant impact on the real estate market. A survey conducted by Pulsenomics indicated that economists believe the effects of student loan repayments will affect home ownership rates for at least a year, with some predicting a longer-lasting impact. Over 75% of survey respondents anticipated a negative effect on home ownership lasting a year or more, while approximately 40% predicted a more extended impact of at least 3 years. Furthermore, economists anticipate that the resumption of student loan payments will lead to a decrease in the U.S. home ownership rate, with an estimated increase in delinquency rates. It is estimated that around 44 million borrowers in the United States were affected by the initial payment pause on student loans, which began in March 2020 at the start of the pandemic. JP Morgan analysts revealed that borrowers are now trying to resume paying approximately $10 billion per month, resulting in a significant amount of money being diverted away from consumer purchases and thereby impacting various sectors of the economy. As a consequence, numerous struggling businesses are expected to face closures and bankruptcies, potentially creating a negative cycle known as a doom loop. The current stability in the markets and institutions should be appreciated, as U.S. banks face multiple concerns and the conditions become increasingly unsustainable. Experts warn that the situation will likely become extremely chaotic sooner than many anticipate. Thank you for watching the video, and we eagerly await your comments.